Good day, and thank you for joining the webinar. I'm Sean Keeling from Easy Equities, and welcome to the webinar with Coreshares on easy access, building a global portfolio using JSE-listed securities. With us today, we have Chris Rule and Michelle Noth from Coreshares. And again, like I said last week in the first webinar we did with Coreshares, this is being the second one, I just want to say I hope you're all keeping safe at home in this lockdown, and thank you for taking the time out for joining us today. And also, again, if you haven't had a chance, please rush over and check out our new ETF website called easyetfs.com, where you can read up and check anything about ETFs. It also is a great tool and be able to compare different ETFs. So thanks again for joining, and over to you, Chris.
Thank you, Sean. And as to reiterate what Sean says, I hope you're all keeping healthy and staying sane during the lockdown period. And a big thank you for you guys for joining us today. And of course, an extension of thanks to Easy Equities and Sean and his team for not only hosting us today in terms of all of their clients on their webinar, but also their new Easy ETF website is a fantastic resource for our clients and for investors in the market to use. So big thank you. I hope we can get some value out of today's webinar. How we're going to do it is we're going to go through the webinar up front, and then we'll take as many questions as you like afterwards. To give you an idea, the last webinar we sat for about 45 minutes doing questions, and we're more than happy to do so. So please, if you've got questions, we'll take them for sure. Any questions investing related or ETFs related, or if it's easy equities or platform related, Sean's going to be here the whole time to listen in. But thank you for your time. My name's Chris. I'm also joined by my colleague Michelle, who's a presenter as well. And today we're talking about easy access, building a global portfolio using JSE-listed securities. That sounds like a bit of a twist in terms, but we're going to show you how it's possible. Before we carry on in terms of moving on to the topic of the webinar, we wanted to do a brief recap on last week's webinar. If you haven't had a chance to go check it out, Sean got it on social media, etc. But we really spoke about the compelling case of passive when investing, how competitive the returns of ETFs are, of passive ETFs, just simple, say S&P 500 funds, how difficult it is to outperform them. The fact that costs are low. I mean, you guys are already using Easy Equities as a platform, which in many respects is key differentiator was their low costs and ease of use. So you're on the right track. And the big thing for clients sitting at home, of course, not only on top of returns, is that you buy one instrument, an ETF, and you get diversification across a whole broad range of underlying shares and securities. So what we wanted to touch on beyond just why ETFs are good this week was how can you use ETFs. Now we want to keep these webinars short and sharp, so 20 minutes is what I'm aiming for. But really, there are a lot of ways you can use ETFs, and this is probably the most commonly used way or the most commonly referenced way. It's known as core satellite. Now, I mean, this is really close to us as a business. Coreshares bases its whole name on the core satellite approach to investing, of course, the core part of shares, where you hold a passive core or an ETF core that looks at getting exposure to a market. As an example, let's just use S&P 500 as an example, where you're getting market returns, you're diversified, you've got very low single stock risk. So, if something goes wrong, in terms of a company-specific risk, you diversify away some of that. And then on the satellite, you can do a number of things, but you could have an individual stock selection, you could have a smart beta or a thematic play or a country play. But essentially, the satellite position is usually a high risk component of your portfolio, which seeks to outperform the core, but does so with, of course, a high level of risk. So, the idea is that if you get your satellite wrong, you've still got your passive core, which diversifies your portfolio and gives you exposure to shares and growth assets. So here's an example of what a core satellite portfolio would look like. And really, this is just, it could take on any iteration, but this is an idea of what it could look like. So you could hold an ETF like the Coreshares S&P 500 ETF, which is JSE listed, by the way. It gives you exposure to the 500 largest shares in global markets. If we think about the topic of today's webinar, which was getting exposure to global markets on the JSE, this is a perfect example of how you can do that. But you hold that as, say, 75% of your portfolio, your core portfolio. But then, as a curious investor,
sorry for butting in there, Chris. I've got a question asking if there's any sound. So I don't know if everyone can just raise their digital hand if they can hear Chris, just so we know that the sound is working.
I can't see the digital hands, Sean.
I can see them. I see there is. Oh, I see. Sorry, the client didn't have any audio there. Okay, sorry, Chris. Can you continue?
Okay, so we all good.
Chris.
Pleasure. So S&P 500 is JSE listed. You can buy it through your Easy Equities stockbroking account, just like you would buy any other share. And I also know that Easy Equities has offshore brokerage capabilities. So this is just an example of core satellite where most of your portfolio is made up with an S&P 500 ETF, in this example. And then as an investor, as someone who does research and does a lot of reading, you're interested in, say, a business like Tesla, include that as a satellite holding of, say, 5%. Microsoft, these are just random examples. These are not our conviction stock picks, by the way. These are completely random examples, but it gives you an idea of how you create this very diverse portfolio, the S&P 500 being hugely challenging to outperform. In fact, Warren Buffett had that famous bet with a hedge fund manager to say, over 10 years, can you outperform the S&P 500? And this was one of the most famous hedge fund managers in the. He then, of course, went on famously to say that he advises that trustees put 90% of their money into a low-cost S&P 500 ETF. He actually recommended Vanguard, which is what we use on the underlying here, and then 10% in cash. So, S&P 500 being very hard to outperform. But, you can take these stock picks. You can, if you're interested in investing and you're doing your research, you can do that. It's just a very sensible way of allocating to other exposures in your portfolio. So this is one way, and this is, as I said, like the kind of the traditional way, broad diversification at the core, and then you can stock pick around it. So we just want to give you guys some ideas of how you can get that exposure. The next way would be almost an inverse of this. So, what we see in South Africa, especially with the professional fund buying market, is that, let's say you're a portfolio manager and your clients use your services for local equities, so for South African equities. Let me use an example of a company who's kind of related to in a roundabout way, but Sanlam Private Wealth. They will service high net worth individuals. So if you've got 10 million Rand, they'll create a South African share portfolio for you. So that might be your competence, and you as an Easy Equities investor might think South African shares like equities is what you really are good at. And then you can use passive or ETFs in your satellite positions for a number of different reasons. Straight away it can improve diversification. So just by buying one ETF, you're improving diversification. But you can use them quite tactically. So you could take tactical positions in, say, JSE listed shares. If you don't have a particular share you want to buy, you could go and buy a top 50 ETF as an example, just to get exposure to the markets when you think they're going to rally. Or alternatively, and we've tried to put forward an example here, let's say you've got your long-term stock portfolio, but then you're moving into retirement and you're starting to look for some income. You can use income-generating ETFs around your normal stock portfolio to create a well-diversified portfolio that's also looking to seek out your particular goal. So in this example, you've got your personal stock portfolio, which is 60%, let's say, of your total portfolio, where you've got, your stock picks. Let's say you own some Anglos and some Naspers and whatever. You've got 20 shares in your personal stock portfolio. Suddenly you're entering into retirement and you've got different needs out of your portfolio. You could combine it with ETFs with a particular outcome in mind. So a property ETF to generate more income, preference share ETF to generate tax efficient income and high yields, or a Dividend Aristocrats ETF, which buys equity shares but with a focus on growing dividends. So, this is an inverse of core satellite, where passive is on the satellite, but you can see how you can iterate, and there's really an unlimited amount of iterations you can do when you are putting together core satellite portfolios. The final way is something that's coming up more and more, and a lot of people are doing this, and this is the ETF Strategist. The ETF Strategist is the kind of investor who's looking who's looking to make asset allocation their primary goal. In other words, getting the right asset class exposures is their main goal, and they're doing that through ETFs. So let's take an example of someone who's really early on in pre-retirement. They'll have an SA equity building block as their main exposure they're looking for. But on that periphery, they may want some South African property, some South African bonds, and then, of course, global equity, global property, and global bonds. All of these you can buy through JSE-listed ETFs. So you can create these fantastically diverse portfolios, with literally exposure to thousands and thousands of shares underlying it with different markets by buying 5 instruments. And it's really fantastic. And this is what's growing globally. Most people are moving away from stock picking because it's so challenging, and starting to use ETFs as their building blocks, or ETFs as their main levers to try and get exposure to the right kind of underlying portfolios. So I've spoken about 3 ways of getting exposure. One is core satellite, using an ETF at the core and then stock around that, or using thematic-based ETFs around that. The second way is actually sticking to your guns as a stock picker, but then using passive in a tactical way in the satellite position, either to get exposures, say like property or preference shares, or alternatively to get quick, efficient exposure to the market. And then the third way is just using ETFs as an ETF strategist. And obviously, Sean's new website, the Easy ETFs, is a fantastic tool if you're an ETF strategist to unpacking some of the differences between the different ETFs. Because even in this instance, selecting between global equity is not as simple as just going and buying a global equity ETF. There are lots of global equity ETFs. So moving on to getting JSE listed offshore building blocks. Now, there's a number of reasons why this makes a lot of sense. Now, I know in the Easy Equities environment, you can actually go and buy offshore shares, but Sean can, I guess, give me the details later. Typically, there's some minimums involved that are a bit more hefty than the local, but Easy might be different on this one. But also, you've got to just be aware of some of the costs involved when going offshore, the currency spread that you pay. So to buy dollars comes at a cost, so on and so forth. But you actually don't need to go offshore to get exposure offshore in this instance. If you've just got a South African Easy Equities trading platform, you can buy US equities on the JSE. The way that we do this is through locally listed shores which reference offshore indices or reference offshore ETFs. The Coreshares S&P 500 is a perfect and probably the simplest example of this, where you buy an ETF that's listed on the JSE, and it gives you exposure to all the underlying 500 largest shares in US markets, and that comes in at a TER of 35 basis points. So really attractive costs. But why go global? So the first thing is, a lot of people see going global as a negative sentiment on South Africa, but it actually is a very reasonable and sensible investment decision. Here we're just trying to show the relative size of the markets. The S&P 500 is sitting at close to 20 times the size of the JSE in terms of, or actually more, with almost 30 times the size of the JSE in terms of the opportunity set. You've also got the opportunity to buy 500 shares or get exposure to 500 shares as opposed to, let's say, 50 in our JSE top 50. So, it really opens up your opportunity set as an investor. Simple example. Now, how do we actually give you, do you actually own those underlying shares? And the short answer is yes, you do. when you buy a JSE listed S&P 500 ETF, either go and buy those 500 shares directly, so the ETF actually holds those shares on your behalf, or alternatively, it might actually go and buy another ETF, which is the case of this S&P 500, which buys the Vanguard S&P 500 ETF, which in turn buys the underlying shares. Now, even we, us as Coreshares, with over R1 billion, buy the underlying shares. You can see
Sorry,
how
Chris,
big
you're coming and going a little bit. I think you're getting excited.
I think you're right, Sean. I'm getting a bit carried away. Is that better, Sean?
Yeah, that's better. Thanks.
Yeah. So I mean, it's a good example of even Coreshares with over R1 billion. It's more efficient for us to go and buy a Vanguard ETF than it is for us to go and buy the underlying. So just to give you an example of the kind of efficiency. Now, S&P 500 is obviously a bellwether for the global economy in many respects, and one of the reasons why it's such a largely referenced index is because it's not just exposure to US equities in a similar way to South Africa having a lot of rand hedges. You know, the global sales driven out of the S&P 500 is actually only around 56% USA based, and a lot of it is offshore based. So, you know, there's a good use case for S&P 500. As I mentioned, S&P 500 kind of the ETFs and the indices flew into popularity when Warren Buffett started talking about them in the mainstream media, but really they've been around forever. And this gives you a kind of exposure that you're getting. And you mustn't forget that when you're buying an ETF, you're actually buying a basket of shares. So you're buying this ETF, you're getting exposure in the top 10 to Microsoft, Apple, Amazon, Facebook, Berkshire Hathaway, which is, of course, Warren Buffett's investment business, Alphabet, which is Google, JP Morgan, Johnson & Johnson. These are the large global leaders. So really neat offshore exposure. Now, for you as an investor to go and buy this and hold it as, I mean, even 100% of your portfolio, to be frank, but 80% of your portfolio and then stock pick around the side, you know, makes a lot of sense for most investors. So this is a quick facts on the ETF. Share code is CSP 500. TER is 38 basis points. With global revenue streams and dividends paid out semi-annually. So some quick facts on that global exposure. If you're looking for something a little different when you're going offshore, we've got a S&P Global Dividend Aristocrats fund. It's a bit of a mouthful, so let's just call it GLODIV. That's the share code as well. So if you're looking to trade it, the share code is GLODIV. And really, it's a globally diversified index of index. So where S&P global fund in all senses, not only of revenue streams, but also where the shares are listed, where it's broken down into the different regions, USA, Europe, Canada, and Pan-Asia. And you can see that it's an index of indices. So you're getting a huge number of underlying shares exposed in this fund. You buy this one ETF and you get exposure to over 300 shares on the underlying, which is really difficult for any investor to go and buy. As I say, even with R1 billion, to go and buy 300 global shares is not efficient at all. So this gives you an example of how it's made up. It mirrors a country allocation, which is similar to any other world ETF you'll see. So USA being 55%, Europe 19%, Pan-Asia 22%, and Canada is a small exposure, but it is in all instances. And then it follows a Dividend Aristocrats methodology that is particular to that country. So if we start at the top, we see the blend index, and we go to S&P 500 Dividend Aristocrats. They require shares to grow their dividends for more than 25 years to qualify for this index. So at the moment, there are only 64 shares in the S&P 500 that have done so. And those are the shares that are incorporated in that particular part of the ETF. Europe is the same concept. They require from the Europe 350, which is the 350 largest European or UK listed shares, they require 10 years of dividend growth, and there are only 56 shares out of those 350 which have done it, and so on and so forth. So you can see years of qualification, slightly different in each region. It's tailored based on each region. And then the weighting is according to a world market cap weighting. So what does this give you? it gives you a global portfolio with a focus on quality income. So the focus is on dividend growth, as you can see, consistency of growing dividends, as opposed to high dividends. These tend to be growth assets with defensive quality. So we'll go through some of the names that are in this portfolio, but they'll come to no surprise as businesses who can grow their dividends through all market conditions. So even crises like we're going through at the moment, there are certain companies who are actually positioned quite well, who are robust companies. They tend to be consumer staples, who grow through these tough times. And how do companies, who keep growing their dividends or keep their dividends consistent, how do they do so? They tend to have robust earnings. As I say, companies are positioned well from a cyclicality perspective. They tend to be super cash generative, have low levels of debt on their balance sheet, and really disciplined management teams who are extremely selective on growth projects. So in other words, they're not just burning through capital and using capital up, kind of willy-nilly on every project that comes along. They are very disciplined on how they deploy capital, and they've got these track records of growing dividends. So that's why you would use Dividend Aristocrats, is you want this kind of exposure to these kind of companies. So different to just buying an MSCI World Tracker as an example. And this is kind of gives you an idea of the kind of companies. As I said, you wouldn't be surprised by the companies that qualify in this portfolio. So some of the brands that pop up there kind of come as no surprise: Coca-Cola, Nestle, Johnson & Johnson, Procter & Gamble. Some other names are names like Unilever, Walmart, some of the big reinsurers. As just as some examples, these are some of the 346 shares that are in the portfolio, just to give you some kind of indication of what's in the portfolio. But really quality. In fact, when we first launched this fund, we spoke about it as our cash cow portfolio. These were the quality businesses. Kimberly-Clark, I mean, that's just, a great example of one of these. So this gives you an example of some of the interesting JSE listed global ETF exposures you can get on our market without actually going offshore. And this gives you some idea of the portfolio. The share code is GLODIV. As I mentioned, a bit easier than the Coreshares S&P Global Dividend Aristocrats as a whole name. The TER is 0.62%. So it's slightly higher. It's got a smart beta allocation, so there's quite a lot more intellectual property that goes into this ETF. But the management fee is actually only 30. So you can see how efficiency is important. This fund has about 600 million Rand in it. It's just gone over 2 years. It's been in the market, it's been around. And dividends are paid out semi-annually. Something to touch on, and it misleads quite a lot of investors, is Dividend Aristocrats is not actually about high dividend yield. It's about quality of yield. It's about being an aristocrat, so that consistency component. But it is higher than an MSCI World, as an example, typically about 20 to 40 basis points above an MSCI World after costs and taxes. So you are getting a bit more. Very interesting that if you go and buy an active global portfolio, you very often don't get any yield out of it because the costs are so much higher than this. The average TER is more like 2%. So, compared to 0.6%, it's a big difference. And usually you actually don't get a net yield as an investor. So that's Dividend Aristocrats. The last ETF that we have, which gives you exposure to global markets and more of a niche market, is the Coreshares S&P Global Property ETF, or GL Prop. This is an interesting concept because people have gone off property. There's a huge recency bias with investors. As property performs quite poorly, people tend to move away from asset classes. But what we just want to remind investors is, why do you have property in your portfolio? Well, it's exposure to, or an age-old asset class in property, but also an asset class that's actually produced very good returns over the long term. So we've done global property here as represented by the same index that we track, the global S&P Global Property 40 Index. This is the longest track record we could get on these indices, or common inception. The S&P Global BMI, which is like MSCI World, everyone knows that one. The FTSE G7 is the bonds, which is the kind of maroony red line, the Coreshares red line, and then USD cash. But you can see the importance of having exposure to equities and property if you're a long-term growth investor. You need this exposure. So a lot of people gone off property in recent history for a number of structural reasons, but we believe there's still place for it in a portfolio. It may not be half of your portfolio, it may only be 5 or 10%, but it's a great way to get exposure to genuine offshore property companies. Now, we do have a lot of offshore property exposure on our market, Napier, Rockcastle, Inchu, Capco, etc. But they tend to be concentrated in the UK and Eastern Europe, but not really global in the true sense of the word, globally diversified. This gives you an idea of how this ETF, the GLOPROP or the GL prop, is exposed globally. So you as an investor might say, I want 5% allocation to global property. For you to go and buy 40 global property shares as 5% of your portfolio becomes extremely difficult. So, you know, a lot of investors who use this fund, and I touched on the professional investor, use this to a large extent to give their clients exposure, efficient exposure to offshore property, where over half of this is based in the UK, at least in the USA. And then a large component in the East, so China, Japan, Hong Kong, making up large exposures in this index. So a great way to go and get exposure to the 40 largest property companies in the world is to buy one ETF, and you don't even need to go offshore to buy that. So this is GL Prop, which is one of the Coreshares ETFs. So it was the first global property ETF on the JSE, and it's sitting with about 500-600 million in assets. And as I say, is really popular in terms of to get quick, efficient exposure to global property markets. These are some kind of quick facts. The 1-year net historic yield of 2.95%, so about 3% as a net yield. Remember, these are dollar yields, so you're probably thinking compared to, say, SA rates, it looks very low, but in dollars, to get 3%, you know, cash is close to zero. It is a reasonably attractive yield. Dividends are paid out semi-annually, and as I say, the 40 largest global property counters in the market. So a bit of a whirlwind trip of 3 global exposures on the JSE. This gives you an idea of our full product set. Go check out Sean's Easy ETFs, you know, a website where you'll see there are loads of global exposures that you can actually buy on the JSE. You know, just simple MSCI World ETFs as a starting point. You can buy, you know, FTSE 100 ETFs. You can buy. There are so many different exposures. There's actually really is very little need to go offshore. And this just gives you an example of the Coreshares list. So